Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Okay, let's unpack this. If you're involved in the tech world, or maybe just trying to make sense of the shifting landscape for startups, you've probably sensed that the traditional exit routes feel a little, well, different lately.
They absolutely do. That golden age of seemingly endless, easy VC money and these guaranteed huge IPOs, it feels like it's firmly in the past.
Especially compared to that peak around 2021, right?
Exactly. Founders, investors, they're all having to get much more creative now about finding that next stage, whether it's growth or liquidity.
And today we're doing a deep dive into what's really emerged as maybe the dominant force in that new landscape, private equity.
Specifically, how PE funds are increasingly becoming the go-to buyer for tech companies, the ones originally backed by venture capital.
And our guide for this is, I think, perfectly positioned. We're digging into a really comprehensive report from Clipperton Finance.
Right, they're a European investment bank, and they've been focused only on tech for, over 2 decades now? Since 2003.
Yeah, a long time. Their report is called The Journey from Venture Capital to Private Equity, the 2025 Guide for Tech Startups. So our mission today is pretty clear.
We want to walk you through Clipperton's insights, right? Understand why PE has become such a major exit option.
And what specific qualities make a tech company attractive to PE, especially in what Clipperton calls the mid-cap or lower middle market.
Which, just to clarify their definition, that's typically companies with enterprise values, say 40 million up to maybe 500 million.
And the debt involved often falls between 20 million and 500 million.
That's the typical range they cite, yeah. It's a really active, significant part of the market that's feeling this shift strongly.
And just as importantly, we want to understand how founders and VCs can best prepare a company for this specific kind of deal.
Because it's really different, isn't it? It's not like prepping for an IPO or trying to get bought by a big strategic player.
Definitely not. And Clipperton, with their long view, they see this as more than just a temporary thing. They call it a fundamental material shift that's here to stay.
Right, and they kick things off by setting the scene, laying out the history. For ages, VC and PE were, Clipperton uses the phrase estranged relatives.
Huh. I like that. Different DNA, basically.
Totally different. VC is like the audacious younger sibling, right? Taking big risks, chasing hypergrowth, often okay with losses initially.
Mostly using equity, taking minority stakes, and really swinging for those huge 10x, maybe even 100x returns. High risk, high potential reward.
Whereas PE was, the calculated older sibling, focused on established markets, proven, profitable businesses.
Using a mix of equity and debt, taking majority control, and aiming for more predictable, solid returns like 2x to 4x, usually over maybe 5 years or so.
Yeah, consistency and a high success rate were always their thing.
But the key point Clipperton makes is this huge convergence that's happening now. Tech has grown up.
Exactly. It's not just about moonshots anymore. Lots of tech businesses, especially software SaaS businesses, they become really predictable.
Profitable, too, generating significant cash flow.
And that's what makes them incredibly attractive to PE funds. They fit the model now.
So this is the heart of the VC to PE deal phenomenon they talk about. VC-backed companies finding a new home with PE.
Yeah, and the data Clipperton presents is, it's pretty stark.
Okay, give us the numbers. How big is this trend, really, especially in Europe?
Well, their analysis looked at European VC-backed companies, ones that raised over 5 million. And PE exits for these companies, they just soared.
Soared from what to what?
From only about 8% of exits back in the 2006 to 2010 period, all the way up to 24% in the latest period they looked at, 2021 to 2024.
Wow, a tripling in the share of exits going to PE. That's a massive shift.
It is. And if you zoom in on that lower middle market we mentioned, the picture gets even sharper, especially in key European tech hubs.
Like France.
Exactly. Clipperton gives this amazing data point for French software companies with exits over 50 million, right in that mid-cap sweet spot.
Okay.
Over the last 4 years, so 2021 to 2024, an incredible 81% of those exits were PE-led.
81%.
Yep. Either a classic LBO or a build-up where an existing PE-backed company buys them.
That number, it just says it all, doesn't it?
Yeah.
How dominant PE has become for those successful growing software businesses in that size range, at least in a major market like France.
And then you look at the alternatives Clipperton mentions, the IPO window. They say it's scarcely open. Strategic M&A, significantly lower than the 2021 peak.
So compared to those, PE just looks like a much more stable exit route right now.
Definitely. So, okay, if you're a founder or a VC, why is selling to PE suddenly so appealing? Clipperton lists several key benefits.
One seems to be keeping some independence, right? Unlike getting swallowed by a big strategic buyer, PE often keeps the management team running the show.
That's a huge plus for many founders. And PE deals, they often have a pretty high chance of success, and they can move relatively quickly.
More certainty than waiting for the IPO market or a long M&A dance.
Generally, yes. PE firms are deal machines. This is what they do. Plus, there's flexibility in how the deal's structured.
Like who cashes out, who stays in, maybe doing a partial exit.
Exactly. Clipperton highlights that flexibility. And for the managers who stay, PE deals can offer really compelling incentives, structured so the remaining equity could be very valuable if they hit performance targets.
And then there's the debt piece. That's a big difference from VC, right? Access to debt financing.
Crucial. And it's not just for the initial buyout. PE uses debt strategically to fund growth, especially those buy and build strategies buying add-on companies.
Which means less dilution for management compared to raising more equity for acquisitions.
Precisely. Using debt minimizes that dilution, and just partnering with a PE fund, a sophisticated financial player, to execute that buy and build plan, that's a major draw.
Clipperton really sees this as a tremendous opportunity for both the entrepreneurs and the VCs looking for an exit.
Absolutely. Geographically, Clipperton points to France and the Benelux region as leaders in this trend in Europe. Almost 30% of eligible tech exits went to PE there between 2021 and 2024.
And the UK wasn't far behind.
Around 23%, yeah. They also name some of the funds you see doing these deals, often Verdane, PSG, Bridgepoint, Nordic Capital, Oakley, Marlin Equity.
A lot of big names. And it sounds like most of this activity, over half, is concentrated in the big markets, France, Germany, the UK.
That makes sense given the maturity of those tech ecosystems. And there's an important nuance Clipperton points out, too. It's not always a PE fund buying a standalone company.
You mean the build-up thing?
Exactly, the build-up transaction, where a PE fund buys a company specifically as an add-on to a company they already own in their portfolio.
Ah, okay. So my tech company might get bought by another tech company that's already PE-backed.
Yes. Clipperton calls it another interesting road. It can actually be quite appealing. Founders might roll over some equity into the bigger combined entity.
And benefit from the resources of the larger platform and its PE owner.
Right. They mention HG Capital as being particularly active here. Think of Visma, that huge PE-backed software group that's grown massively through tons of add-on deals. That's a prime example.
Okay, so we get the why and the scale of this trend, especially in that European mid-market, thanks to Clipperton's overview. But let's get practical. What exactly are PE funds looking for in these VC-backed companies, particularly in this size range?
Yeah, this is where Clipperton gets really specific. Now, PE can look at different tech assets, but they're increasingly drawn to SaaS, software as a service.
Why SaaS specifically?
Well, think about it. SaaS models often have great characteristics for PE. Potential for structural profitability, they're asset light, usually have strong margins, and crucially, they offer predictable, recurring revenue.
That predictability is gold for PE, especially if they're using debt, right? Cash flow visibility.
Exactly. So the ideal candidates, according to the report, they're often SaaS businesses that manage to combine steady ARR growth with capital efficiency.
Meaning they're either profitable already or they have a really clear, believable path to getting there soon.
Yep. And strong customer retention is basically non-negotiable. They need to see you're keeping your customers.
What about the team?
Oh, absolutely critical. Clipperton stresses the quality of the management team. They want experienced leaders with a clear vision, proven execution skills.
And crucially, the ability to scale the business further. maybe even lead that buy and build strategy we talked about.
That's paramount. And Clipperton gives us a really helpful look at the key metrics PE uses for evaluation. They even define the target size for PE readiness in this market quite clearly.
Okay, what are the thresholds?
They say companies with 10 million to 30 million in annual recurring revenue, or ARR, or just revenue, are seen as good candidates. And if you're over 30 million, you're looking like a great candidate.
So that really reinforces their focus on this specific lower middle market or mid-cap segment.
It does. And beyond just size, they look at growth rate, obviously gross margin, and really importantly, EBITDA margin, how profitable the core operation is.
And the SaaS specific stuff.
Oh, yeah. They dig deep into that. Net dollar retention, or NRR, basically, how much your existing customers are spending over time, including upsells. Very important.
What else?
CAC payback, how fast you earn back the money you spent acquiring a customer. And the burn multiple, how much cash you're burning for each new dollar of growth.
And the rule of 40 comes up too.
Yeah, the general idea that your growth rate percentage plus your profit margin percentage should ideally add up to 40% or more. It's a common benchmark.
And what about the management team staying on?
Huge factor. They want to see significant management rollover. Clipperton suggests that for a great candidate, PE expects over 80% of the key management team to reinvest and stay committed.
Makes sense. They're backing the team.
Totally. And to make this less abstract, Clipperton provides 3 really good concrete examples of companies showing how PE might evaluate them. Helps put flesh on the bones.
Okay, lay them out for us. Company A.
Company A is a mix of SaaS and licensing. Pretty decent size at 40 million revenue, growing steadily, maybe 15-20%, and already nicely profitable, 30% EBITDA margin.
So Clipperton's view.
Definitely attractive for PE. It hits the sweet spot. Size, profitability, decent growth, and probably good potential for bolt-on acquisitions. Ticks a lot of boxes.
Right, scale plus profit is a clear winner. Okay, Company B. This one's different. Vertical SaaS, smaller at 15 million ARR, but faster growth, 30%. The catch. It's currently losing a bit of money, Medica 5% EBITDA margin.
Here, Clipperton says, probably attractive. This is interesting. Even though it's not profitable yet, the strong recurring revenue, the good growth, the scalability of SaaS makes it compelling.
So PE might see potential they can unlock.
Yeah.
Help them get to profitability.
Exactly. They might figure they can optimize things, leverage the growth. It shows PE isn't only buying deeply profitable firms anymore. They're getting comfortable with growth assets if the path to profit is clear.
That is an important shift. Okay, finally, Company C, B2C commerce. Big revenue, 100 million. Super high growth, over 40%. But also losing more money, negative 10% EBITDA margin.
Clipperton's take here. Unlikely to be a good fit for a typical PE buyout.
Why not, despite the size and growth?
Well, the lack of profitability is one issue, maybe cash flow problems. But more fundamentally, B2C e-commerce often lacks that predictable, recurring revenue that PE, especially using debt, really prefers. It's just not the same profile as a B2B SaaS company.
Got it. Those examples really clarify the kind of profile PE is targeting in this mid-market segment.
They really do. Now, once a deal is done, how does PE add value? The report touches on operational improvements, obviously.
Like refining the go-to-market, sales efficiency, bringing in talent, sorting out the back office, that kind of thing.
Yeah, all the standard operational levers. And we keep coming back to it, but that buy and build strategy is often central.
Acquiring other companies, getting synergies, expanding the market, often using debt to help fund it.
Exactly. That's a major plank of the PE value creation story post-acquisition.
Which leads us nicely into the financing, particularly the leverage buyout or LBO structure PE is famous for. Can you break that down simply?
Sure. In basic terms, PE sets up a new company. Let's call it NewCo. NewCo buys the target company using a mix of the PE fund's own money, their equity, and a significant chunk of borrowed money debt.
And that debt is secured against the company being bought.
Right, against its assets and its future cash flows. The whole idea is that the target company's own operations will generate the cash needed to pay back that debt over time.
And that leverage, using borrowed money, that's key for boosting PE's returns and funding growth.
It is. It magnifies the potential return on their equity investment. And it provides cash for things like those add-on acquisitions without deleting the owners as much as raising new equity would.
Good for management staying on, too. Potentially less dilution for their stake.
Can be, yeah. But Clipperton is clear it adds risk, too. There's real pressure on the company to generate enough cash to service that debt. No free lunch.
Makes sense. Now, Clipperton outlines different types of financing used here. There's the traditional classic LBO financing.
Yeah, that's based on the company's historical cash flow, its EBITDA. Usually for more mature, consistently profitable businesses.
But for tech, especially SaaS, there's something newer. AR financing.
Right. This is increasingly relevant. Instead of being based just on past profits, it's based on a multiple of the company's annual recurring revenue.
Designed for those growth stage SaaS firms that might be only break even, but have super predictable revenue streams.
Precisely. Clipperton notes it might be a bit less liquid, a bit less common than traditional debt today, but it's growing fast as lenders get more comfortable with SaaS models.
And who's actually providing all this debt capital? Banks.
Well, traditionally, yes, but Clipperton highlights a massive shift in Europe. Private debt funds have really taken over the LBO market.
How much?
They accounted for something like 64% of the LBO deal financing in Europe between 2021 and 2024. It's huge.
Wow. Why the shift away from banks towards these private debt funds?
Clipperton points to a few things. Private debt funds often offer more leverage, meaning they'll lend more money up front. Their repayment terms can be more flexible too, maybe like bullet payments where you pay it all back at the end.
Faster, more flexible to work with, maybe?
Often, yeah. Now, they usually cost more. The interest rate is higher than bank debt. But that flexibility, the higher leverage, especially for funding buy and build plans in this mid-market space, often makes them the preferred choice.
And there's also junior debt. Sits below the main senior debt.
Yeah, it's subordinate, riskier for the lender, so it costs even more. But it's another way to push the leverage higher in the deal, maybe minimizing the equity check needed, which can help management's stake.
So lots of financing options. But what's the key thing lenders focus on? They must look at deals differently than the PE equity folks.
Absolutely. Clipperton stresses this. Lenders are fundamentally risk-averse. Their main goal is getting their money back with interest.
So they care less about the massive upside potential and more about the downside risk.
Exactly. They scrutinize historical financials, the predictability and resilience of revenue, especially recurring revenue, the overall business stability, and crucially, the company's capacity to generate cash to pay the debt. Future projections are secondary to proven performance.
And for those ARR lenders,
they're laser-focused on the quality and predictability of those recurring customer contracts. How likely is that revenue to actually keep coming in?
Okay, so understanding what PE wants and how deals get financed is vital. But the next section in Clipperton's guide really hammers home a point. Getting a PE exit done isn't easy. It needs serious preparation.
Absolutely critical. They say, unlike maybe some simpler VC rounds, PE exits are complex and demand thorough preparation. You can't just wing it.
So what does that preparation involve? What's top of the list?
Well, one key point they highlight is prioritizing profitability. Even if you're not there yet, you must have a clear, credible plan to reach profitability soon.
They mentioned something called normative EBITDA. What's that?
Yeah, that's about adjusting your financials to show the underlying profitability. You basically strip out one-off investments made specifically for future growth, things that won't recur at the same level.
To give PE a clearer picture of the core business's earning power.
Exactly. But it needs careful accounting and clear justification. You can't just make numbers up.
They also circle back to the management team again.
Of course. Need a strong, experienced team. PE funds are backing these people to execute, remember. Especially if there's a buy and build plan involved. They need confidence the team can handle M&A integration and scaling.
And for SaaS companies, those KPIs we talked about.
Non-negotiable. Meticulous tracking and reporting. NRR, churn, CAC, payback periods, all of it. You need clean, consistent, well-documented data ready for deep scrutiny during due diligence.
That sounds like a lot of work.
It is, and Clipperton advises being proactive on external growth, too. Start identifying potential acquisition targets before you even start talking to PE funds.
Why? To show you're serious about buy and build.
Precisely. It shows you have a vision and you're ready to hit the ground running once they invest.
And handling all this complexity, the diligence, the negotiation, the financing, they stress needing strong internal teams.
Yeah, structured finance, legal support, maybe even a corporate development function. It's a heavy lift, and you need internal capacity alongside your external advisors.
Which brings us to maybe Clipperton's most crucial piece of advice, getting expert help.
They basically say it's a necessity, not a nice to have. Navigating a PE buyout needs specialized expertise. You just can't do it effectively on your own.
Like investment bankers, Clipperton themselves, for example, and specialized lawyers.
Exactly. They play vital roles, assessing if a PE deal is even the right path, crafting the story for investors, running a competitive process to get the best valuation and terms,
Managing that intense due diligence phase.
and crucially, negotiating all the complex details, not just the price, but the terms for the VCs exiting, and critically, the package for the management team rolling over their equity, incentives, governance rights. It's intricate.
They also mention VCs and experienced board members, with PE connections playing a bigger role now, too.
Yeah, that network and experience is invaluable. And finally, on the financing side, preparation is key there too.
What do they suggest?
Running a lender education process. Basically, talking to potential debt providers early, in parallel with talking to PE funds.
Why? To make sure the debt is actually available.
Yes, and to structure it favorably, and importantly, to get certainty of funds. PE buyers need to know the debt is lined up when they make a binding offer. It takes coordination.
So, pulling this all together, this deep dive into Clipperton's report really paints a clear picture. There's been a major shift in tech exits, especially for these mid-market European companies.
Yeah, their conclusion is pretty firm. The old lines between VC and PE, they're genuinely blurring. And this VC to PE trend isn't just a blip. It's material and here to stay.
It's moved from the edge case to being a core part of the playbook now.
Definitely. And the key takeaways for attracting PE in this segment are clear, right? Focus on capital efficiency, show that path to profitability, keep growth steady, lock down customer retention, especially if you're SaaS.
And preparation.
Yeah.
Clean financials, strong team, perfect KPIs, have an M&A plan, build internal support, and get top-notch advisors.
Couldn't say it better. Looking ahead, Clipperton offers a few predictions for the next, say, 5 to 10 years.
What do they see coming?
One more blurring of the lines. They expect the rise of more hybrid funds that kind of blend VC and PE strategies.
Makes sense. And just more of these VC to PE deals happening.
Increased frequency, yeah. As the market matures, everyone gets more comfortable. They also see continued growth and wider use of that ARR financing we talked about.
Making PE accessible to even more growth stage SaaS firms.
Potentially, yes.
Yep.
And they also predict more PE funds will start targeting companies that are maybe just quasi-break-in, slightly unprofitable, but with that clear, credible path to strong profits soon.
Pushing further into what used to be later stage VC territory.
Exactly, further blurring those lines. And finally, they just expect more collaboration generally between VC and PE firms, recognizing they can work together to build and exit great tech companies.
And Clipperton, given their focus in 2 decades in this European tech mid-cap market, they're really well placed to see this firsthand.
Their report is just an invaluable framework for understanding this whole shift. It's happening right now.
So we've taken a deep dive into Clipperton's comprehensive report. Hopefully this gives you a shortcut to understanding this major force reshaping tech startup exits private equity, particularly how it's impacting companies in that crucial lower middle market segment.
Yeah, you should now have a clearer picture of what PE is really looking for, those specific qualities, and also the non-negotiable steps you need to take to prepare, all informed by Clipperton's deep experience on the ground in Europe.
This knowledge is really key for anyone trying to navigate or just understand the tech investment world today.
Absolutely. Whether you're a founder thinking about your options, an investor looking at liquidity, or maybe you're just trying to stay informed on industry trends, you hopefully have a better grasp of this powerful third-way exit route now.
And the specific factors driving its success. So let's leave you with something to think about as these lines between VC and PE continue to blur.
And as the typical PE structure, which almost always involves bringing in significant debt, becomes a more common path for companies that were initially built purely on equity from VCs.
What does that fundamental shift in the capital structure, bringing leverage into the equation much earlier or more significantly, what does that mean long term?
Yeah, for strategic decisions, for the company's risk profile, maybe even for how we define a successful startup or scale up.
Does relying more on debt fundamentally change the trajectory compared to, say, a purely equity-funded exit like a strategic sale or even a high-risk IPO?
It's a really fascinating evolution to watch, something to definitely mull over.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors. And we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.